Most self-employed people do not have a tax strategy. They have tax theater, they buy structures they do not understand, chase deductions that do not touch the real problem, and congratulate themselves for moving numbers around while the machine keeps taking exactly what it was always going to take. I will tell you the brutal truth the way I would tell it if your name were on a stack of operating reports sitting on my desk. If you work for your own money and your hands, your voice, your judgment, your calendar, and your labor are still the thing producing the profit, then you are standing inside the active income machine, and that machine has a meter on it. You can ignore the meter, you can decorate the outside of the machine, you can put an LLC sticker on it, you can buy a rental house on the side, you can let your spouse start a different business that loses money, you can watch 100 cheerful videos about tax hacks, but if you never touch the meter, you never touch the pain. That is why so many self-employed people feel cheated. They are not stupid. They are not lazy. They are looking at the wrong machine. When you are an employee, payroll tax is split in a way that makes the pain easier to miss. Some comes out where you can see it. Some is paid by the employer where you do not feel it as directly. The system hides part of the wound from your eyes when you become self-employed. That cosmetic trick disappears. Now you are both sides of the arrangement. You are the worker and the employer. You are the labor and the payroll department. You are the employee and the business that hired the employee. That is why the number feels like a slap. It is not that the tax suddenly became evil. It is that the costume came off. The first time many people really see that number, they panic. They say, I only made $50,000. They say, I did not get rich. They say, why does this feel like I am being taxed like a criminal? And the answer is simple, because you are now paying income tax, maybe state tax, and the active income tax layer that used to be partially hidden from view. You are not looking at one drain. You are looking at several drains opening at once. If you do not understand that, you spend the next 5 years in tax cosplay. You become a collector of tactics. You confuse motion with progress. You begin to think that every deduction is equal, every entity is magic, and every smart sounding conversation with a tax professional must be saving you money because it sounds sophisticated. That is how ordinary earners get trapped, not by low intelligence, by category error. They are fighting income tax when the deepest pain they feel is coming from active income exposure. This is why I want you to stop thinking like a shopper and start thinking like a capital allocator. A good capital allocator always asks one question first. What machine is producing the result? Not what story feels good, not what social media likes to repeat. What machine is producing the result? If the result is self-employment tax pain, then you need to know exactly what machine produces self-employment. The answer is active labor income. You working in the business, you being the engine, you showing up, performing services, generating profit through your own activity, and then asking the government to kindly ignore the fact that you are both worker and employer. It will not. That is not how the machine is built. Now let me show you where people waste years. The first fantasy is real estate. I have watched people comfort themselves with this one for decades. They hear that real estate has tax benefits, and that part is true in the right context. Real estate can be wonderful for many reasons. Depreciation can matter. Appreciation can matter. Timing can matter. Asset selection can matter. But if you already have active business income that is getting hit by self-employment tax, buying a rental property does not reach backward in time and erase that active income exposure. You do not cure one machine by standing next to a different machine. What happens instead is psychological damage. You think you did something sophisticated. You think you got strategic. You think you moved the needle. Then the return arrives and the pain is still there. That is expensive, not just financially, but mentally, because bad strategy does not merely cost money. It corrodes trust in reality. The second fantasy is the LLC. I am not against legal protection. I like durable structures. I like clean paperwork. I like proper separation. But if you are using an LLC as a spiritual object instead of a tax analysis, you are praying to the wrong God. An LLC by itself is not the miracle most people think it is. A single-member LLC by default does not wave a wand over your federal tax treatment and make active income float away. A multi-member LLC does not automatically make labor income immune either. If the underlying economics still say you are actively earning the money, the machine still recognizes the work for what it is. You changed the label on the box. You did not change the engine inside the box. The third fantasy is my favorite because it shows how desperate people become when they want arithmetic to rescue them from structure. One spouse has an active business making real money. The other launches something else that loses money. On paper, the household says, look, we lost over here and gained over there. Surely the pain disappears. That may affect income tax in certain ways on a joint return. But self-employment tax does not care about your wishful blending of identities. It follows who earned the active income. It follows the person standing in the machine. If one person produced the active earnings, the other person's unrelated loss does not magically reach in and pull that worker out of the active income tax box. You need to let that sink in. Tax pain often persists not because you failed to do something fancy. It persists because the law keeps asking the same cold question. Who actually earned this active income? That is the question. Not who married whom. Not who opened what entity. Not who read 3 threads online and felt clever. Who earned the active income. Once you understand that, a lot of fake sophistication dies. And that is good news. Because once fake sophistication dies, real strategy can begin. I have spent my life looking for the few variables that matter and ignoring the noise around them. That is true in investing. It is true in business. It is true in life. And it is absolutely true in tax planning. Most people are romantics about tax. I am not. I want the small number of levers that actually move reality. And when it comes to self-employment tax, there are only a few levers worth your time. The first is to understand the difference between return on labor and return on capital. That difference is not academic. That difference is the whole game, when money is being paid to you because you worked, served, managed, produced, sold, advised, or otherwise operated as the active force in the business. The machine reads that one way. When money is being paid to you as a return on invested capital under a structure that genuinely fits that economic reality, the machine may read it another way. That is why limited partner treatment becomes important in the narrow situations where it genuinely applies. Notice the phrase I just used, where it genuinely applies. That is where adults live. Children want shortcuts. Adults want accurate classification. If you are truly a limited partner under the law, functionally limited, economically situated as capital rather than disguised labor, then you may be standing in a very different part of the machine. But if you are using words as camouflage while still behaving like the active operator, you are not doing strategy, you are buying future trouble. Substance always matters more than costume. The second lever is the one the internet loves to oversimplify, the S corporation. Now here is where ordinary people get dangerous, because a little information mixed with greed creates formulas, and formulas make people feel safe. Pay yourself 30%. Pay yourself 40%. Here is the secret split. Nonsense. The world does not hand you a legal standard and then let your favorite podcast turn it into a bumper sticker. The real issue is not whether someone online likes a certain percentage. The real issue is whether the salary is reasonable for the services actually performed. That means you have to think, That means you have to ask what would ordinarily be paid for like services by like enterprises under like circumstances. That means reality, not folklore, and timing matters. This is where greed punishes the impatient. If your business is still small, still fragile, still barely generating enough profit to compensate your actual work, electing S corporation status too early can become expensive theater all over again. More compliance, more administrative burden, more moving parts, maybe very little tax difference, because most or all of the earnings still need to be paid out as wages anyway. That is what self-employed people hate hearing. They want the move to be right now. They want a switch. They want the machine to change because they signed a form. But good strategy is not form worship. Good strategy is economic timing. The S corporation only becomes a meaningful lever when the business is producing enough profit that you can pay a truly reasonable salary for the services you actually perform and still have excess earnings left above that salary. That excess is where the shift matters, not before. Before that, you are often dressing up a sapling like an oak tree. This matters for another reason that almost no one talks about honestly. As a business grows, the value of your services does not necessarily rise as a fixed percentage of profit. That sentence can save people from years of stupid advice. A bigger business may throw off much larger profits while the reasonable value of the specific services you perform does not scale in lockstep. That is where sloppy percentage rules mislead people. The business can get stronger, the distributions can get larger, but wages do not automatically rise on autopilot because some internet formula said they should. You are not running a superstition shop. You are running an economic organism. The law asks what the services are worth, not what a meme said. The third lever is the one almost everyone thinks they understand and almost nobody implements with enough precision. Deductions inside the business. This is where self-employed people get emotionally attached to the word deduction and then stop thinking. They hear retirement plan. They hear health insurance. They hear depreciation. They hear accountable plan. They hear benefits. They hear write-off. And they assume every one of these words reaches straight into the active income machine and lowers self-employment tax automatically. That is not how adults think. The real question is whether the deduction is properly tied to the active trade or business owned by the same taxpayer whose net earnings are exposed. The placement matters, the attribution matters, the implementation matters, the timing matters, the facts matter. A deduction is not powerful because it exists. A deduction is powerful when it is structurally connected to the tax base you are actually trying to reduce. That sounds technical. Good. Reality is technical. The danger in wealth building is not complexity itself. The danger is pretending complexity can be bypassed with vibes. This is why so many self-employed people feel like they are drowning even as revenue goes up. They are confusing revenue with retained capital. They are confusing gross with net. They are confusing motion with structure. They are confusing tax content with tax planning. And they are confusing emotional relief with mathematical improvement. You can make more money and still feel poorer. I have seen that pattern my entire life. A man starts a business because he wants freedom. At first the thing is small. He works like a mule. He says it is temporary. Then the revenue improves. The invoices get bigger. Friends start congratulating him. He thinks he crossed into the territory of owners. But he did not become an owner. He became a highly taxed employee of his own demand machine. He works. The machine bills. The machine collects. The machine spends. The machine remits. And at tax time, he discovers that the business did not free him from the system. It made the costs easier to see. That is why many self Employed people are psychologically exhausted in a very specific way. Employees feel controlled from the outside. Self-employed operators often feel betrayed from the inside. They thought they were building autonomy. Instead, they built a louder mirror. That mirror shows them something they do not want to admit. Their business may not yet be a capital machine. It may simply be a labor machine wearing entrepreneurial makeup. That is a painful realization. But pain is useful when it is honest. Once you see that, you can stop treating self-employment tax like a random punishment and start treating it like a signal. The signal says this: your income is still heavily dependent on you functioning as labor. That does not make you a failure. It makes you diagnosable. And diagnosis is where power begins. Now, let me make the economics even more personal. Suppose you clear respectable top-line revenue as a freelancer, consultant, coach, agent, designer, or operator. The money hits your account and your ego gets louder before your judgment gets sharper. You look at the deposits and think the business is finally breathing. But the active income machine does not care about your optimism. It begins cutting before you feel secure. Income tax starts taking its share. State tax may take another bite. Then the self-employment layer sits on top of the same labor stream and reminds you that nobody was quietly paying the other half for you anymore. Now add software subscriptions. Now add a bookkeeper. Now add a contractor or two. Now add office expenses. Now add the mental fatigue that causes sloppy personal spending because you tell yourself you earned it. This is how people make good money and still build no fortress. They have activity, they have motion, they may even have status, but they do not yet have retained power. And retained power is the only kind of money that changes your life. Everything else is temporary noise moving through your hands. That is why I want you to stop asking, how do I make this bill feel smaller, and start asking, what kind of business am I actually running? Am I running a business with transferable economics? Or am I running a disguised job with invoices? Am I building margin, or am I just widening my stress? Am I buying tools because they truly reduce the right tax base, or because the word business expense gives me emotional comfort? Am I adding structure because the economics now justify it, or because I am insecure about looking small? Those are brutal questions. Good, brutal questions build durable lives. There is another mistake I want you to kill before it kills years of your life. A lot of self-employed people think tax planning starts when profit gets large. Wrong. Tax planning starts when honesty gets large. Before you can optimize anything, you need clean books. Before you can defend anything, you need documentation. Before you can classify anything, you need to know who performed what services, who owned what activity, and where the money actually came from. That sounds boring. It is boring. So is reading an insurance contract. So is checking the debt maturity schedule on a company. So is counting inventory correctly. Boring is where grown-up money lives. The self-employed people who win are usually not the most dramatic. They are the most precise. They know that real estate may be excellent for one objective and irrelevant for another. They know that legal entities solve some problems and not others. They know that income tax planning and self-employment tax planning overlap in places, but are not the same conversation. They know that one person's loss is not a magic eraser for another person's active income exposure. They know that an S corporation is a timing, sensitive tool, not a personality trait. And they know that when deductions matter, they matter because they are correctly attributable, properly implemented, and living inside the same economic machine they are supposed to affect. That is not sexy. It is profitable. And profitability is what buys refusal power. I care a lot about refusal power, the ability to say no, the ability to reject bad clients, the ability to walk away from an ugly contract, the ability to pass on work that pays well but poisons your life, the the ability to stop making every decision from a place of tax season panic. You do not buy that with slogans. You buy it by building a cleaner machine. A cleaner machine does three things. It tells the truth about labor. It protects the distinction between labor and capital. And it only adds structure when structure is economically earned. That is how you go from feeling punished to feeling intentional. This also changes your psychology. The self-employed person who does not understand the machine becomes superstitious. He starts attributing outcomes to random talismans. He says, my friend got an LLC and pays nothing. He says, another guy bought a property and wiped out his bill. He says, somebody online pays himself 20% and the IRS never cares. He says, maybe I just need a better write-off guy. That is not strategic thinking. That is tribal storytelling. You do not need a tribe. You need a framework. Frameworks are what protect you when social proof gets loud. And the framework here is mercilessly simple. If the income is driven by your active services, the machine will read it that way until the economics and the structure truly justify something else. So stop trying to out-charm the machine. Start redesigning your relationship to it. Maybe that means accepting that your current stage is still heavy labor and planning accordingly. Maybe it means growing profit before forcing an S-corporation election. Maybe it means finally setting up the retirement and benefit structures correctly inside the business, instead of talking about them forever. Maybe it means cleaning up reimbursement practices through an accountable arrangement, instead of blending business and personal spending like a teenager. Maybe it means understanding that depreciation only matters when it is attached to the right asset inside the right activity with the right taxpayer. Maybe it means your tax problem is not that you lack ideas. Maybe it means you lack sequencing. Sequencing is everything. In investing, a great asset bought with the wrong leverage can ruin you. In business, a great market entered with the wrong cost structure can ruin you. In tax, a correct tool used at the wrong stage can ruin the benefit and leave you with the burden. That is why serious people do not ask only whether something works. They ask when it works, for whom it works, under what facts it works, and whether the economics actually support it. That is what I want you to become, not a seeker of hacks, a reader of machines. Because once you can read the machine, you become difficult to fool. You stop chasing emotional relief. You stop buying paperwork as therapy. You stop mistaking sophistication for savings. You stop admiring complexity for its own sake. You stop worshiping the form and start interrogating the substance. That is how adults keep money. There is another thing worth saying plainly. A lot of self-employed people do not actually want lower tax. They want emotional revenge. They want the feeling that they outsmarted the system. That desire is understandable and dangerous. Because once revenge becomes the goal, you become easy to sell. You buy complexity for the thrill of defiance. You pay fees to feel sophisticated. You force structures before the economics justify them. You start resenting the law instead of understanding the machine. And resentment is a terrible allocator of capital. I would rather you be cold. I would rather you be clear. I would rather you say this income is active. Therefore, this tax exposure is telling me what stage my business is in. I would rather you say this deduction helps income tax, but not the active income layer that is currently hurting me most. I would rather you say this LLC protects certain legal risks, but by itself it does not perform tax miracles. I would rather you say, I am not yet big enough for the S-corporation move to produce meaningful savings after reasonable salary and compliance costs. I would rather you say this is not a shortcut business. It is a sequencing business, because that is how people actually get rich. Not by insisting reality be prettier, by understanding sequencing. There is a sequence to escaping this machine. First, you understand the pain correctly. Then you stop using fake solutions. Then you build enough real profit to make the correct structure matter. Then you classify labor and capital honestly. Then you implement deductions inside the right business with the right taxpayer attached to the right tax base. Then you let economics, not vanity, decide when to change form. Then over time you push more of your life away from being purely labor. Metered, that is the whole mission, not merely lower tax. Build a life in which less of your financial destiny depends on you standing in the active income machine every day. That is the part ordinary people miss. Tax planning is not just about reducing a bill. At the highest level, it is about changing the kind of income your life depends on. Labor, dependent income, has one character. Capital, supported income, has another. A fragile operator who must show up to keep the whole thing alive lives differently from a rational owner who has systems, margins, structure, and correctly classified flows. One lives in reaction, the other lives in design. And design is where freedom begins. So when people ask me what they should do, I do not start with tax tricks. I start with truth. Tell me what the business actually is. Tell me what the owner actually does. Tell me how much profit exists before compensation games. Tell me how the books are kept. Tell me whether the deductions are real, attributable, documented. Tell me whether we are early, middle, or mature in the life of the business. Tell me whether you want a smaller bill or a stronger system. Those are not the same goal. A smaller bill today can be purchased in foolish ways. A stronger system pays you longer. I like what pays longer, always, because this is not just about April. It is about identity. The self-employed person who understands the machine stops behaving like prey. He stops getting seduced by every strategy that sparkles. He stops collecting structures the way insecure people collect luxury goods. He becomes quieter. He becomes harder to impress. He becomes more exact. He starts asking whether an idea changes the active income exposure, changes the classification, changes the attributable deduction base, changes the economic shape of the business, or merely creates paperwork. That is when adulthood begins, and adulthood is highly profitable. You do not need to know every section of the tax code by heart. You do not need to become a lawyer. You do not need to perform brilliance, but you do need to stop pretending that slogans are strategy. You do need to stop saying, I have an LLC, as though that answers anything. You do need to stop buying assets for one tax problem when those assets only address another one. You do need to stop letting household narratives blur the question of who actually earned the active income. And you do need to stop treating the S corporation like a trophy instead of a timing-sensitive tool. That is your escape path, not a secret, a discipline. This is why I always come back to one principle: name the machine correctly. Once you name the machine correctly, half the stupidity falls away. If the machine is active labor income, then own that. If the machine can now support a reasonable salary plus excess profit, then analyze that. Honestly, if the machine is producing deductions that truly belong inside the same business and reduce the right base, then implement them cleanly. If the machine is still too small, too young, too dependent on you, then grow up before you dress up. A child wants to look rich. An adult wants durable economics. The same principle applies here. A child wants to look strategic. An adult wants a structure that survives scrutiny. And now I will give you the test, not the tax test, the character test. When you finish hearing all of this, what do you do next? Do you go hunting for one more shiny tactic so you can keep the fantasy alive that some clever trick will save a business that is still just your labor with better branding? Or do you sit down, open the numbers, and ask the only question that matters? What machine am I really running? If your answer is that you are still running a labor machine, then face it without shame and start building toward the day the economics justify something better. If your answer is that the business now has enough real profit, enough structure, enough stability, and enough separation between the value of your services and the residual earnings of the company, then act like an owner and treat the structure with precision. If your answer is that you have been confusing tax entertainment with tax planning, good. That realization may save you years. You are standing at a door now. On one side is vanity. On the other side is design. On one side is the urge to sound smart. On the other side is the discipline to classify reality correctly. On one side is a business that keeps feeding the machine while you tell yourself stories. On the other side is a business that grows up, gets honest, and slowly moves more of your life out of the meter. Choose carefully, because the machine does not care what you hoped. It only cares what you built.